Hey everyone, this is Elijah Johnson with SilverDoctors.com, and back with us today is John Rubino, co-author of The Money Bubble and host of the website DollarCollapse.com. John, thank you so much for joining us today.
Hi Elijah, good to talk to you again.
All right, now last week we saw a big drop in the stock market, about 1,000 points for the Dow. It's rebounding a bit. And we also saw this around the world, a decline in stock markets. Why do you think we saw such a big drop last week?
Well, there are a couple levels of explanation here. First is that stocks never should have gotten this high. So the fact that they're going back down is just normal valuation exerting its pull on excessive valuation. So in the absence of anything else going on in the world, stocks at this level of valuation ought to revert to mean sometime, somehow. And so, so this happening now isn't that big of a surprise. But there are some specific things going on that are kind of the immediate cause of turmoil in the financial market. One of them is interest rates are going back up. We have had unnaturally low interest rates for an unnaturally long time in this recovery. And that has distorted the financial markets in a lot of ways. One way in particular affects stocks. But by making capital or cash really, really cheap for corporations, we've incented them to buy back their own stock. In other words, if you're IBM, let's say, and your stock dividend is 2 or 3%, but in today's world, you can borrow money for 1%. And use that to buy back your stock and take that stock out of circulation. That means you don't have to pay those dividends. So you're borrowing at 1% in order to save 2 or 3%. And you're doing it basically, in the short run at least, risk-free. So you're generating free cash by buying back your stock. And corporations across the spectrum in the U.S. have been doing that for the last 6 or 7 years. And that's part of what pushed up the stock market. We've basically been LBOing the corporate sector in the U.S. In other words, we've been borrowing money and buying back stock and shrinking the amount of stock that's out there, and that pushes the price of shares up. By the way, it also makes corporate earnings look better because there are fewer shares upon which to calculate earnings per share, and that results in bigger year-end bonuses for corporate executives. So it's a win-win for the 1%. And they've been doing it for quite a while. And then this last year's tax reform incented companies to bring back the money that they've been stashing overseas because they didn't want to bring it back and pay taxes on it. Well, now the taxes are lessened. So they're bringing back, by some estimates, $1 trillion this year. And a lot of that is going into share repurchases. So with interest rates going up, a lot of this stops being economic for corporations. In other words, if you have to pay 3 or 4% for money and your dividend yield is still 2%, it doesn't generate free cash to borrow that money and buy back the stock. So you would think, other things being equal, that we'll see a lessening of corporate share repurchases. And that could be what's affecting people's opinion about stocks right now. They see this coming. And they think, okay, that's one of the big drivers of share prices. Take that away, and maybe these rich valuations aren't justified anymore, so maybe I'll take some money off the table. And that's really all it takes to put air pockets under some of, especially these big tech companies. Amazon and Google and Facebook have had such huge runs that they can lose 40% and still be fairly valued, maybe even still overvalued based on some measures of earnings and cash flow. So in that sense, this really isn't that unusual. You see this at the peak of every cycle. For instance, in 2006, 2007, 2008, corporate share repurchases went through the roof. And then interest rates went up and stocks tanked, and corporate share buybacks tanked along with them. So we're seeing a repeat of that very probably, although we don't know for sure if this is the turn. This could just be a squiggle on the way to ever higher share prices. You can't know the end of a cycle. You can't identify it until after the fact. You got to look back a year and say, oh yeah, on December 17th, that's when this thing ended. And so while you're involved in it, you don't know whether it's a buy the dip opportunity or a sell the rip opportunity. And when it happens, when the cycle ends, stocks go back to their intrinsic value, which is about 50% of today's prices, and the economy drops back into recession, the beginning part of it will feel like last week. We don't know if last week was that beginning, but that's what it'll feel like. So it was exciting. It got some animal spirits going for the shorts. People who have been waiting for a really long time for stocks to turn, and finally got a little bit of their losses back last week. So, and I'm one of them to an extent. So it felt good to finally be right about the prices of some of these things.
No, you were saying that it looks like probably a 50% decline. That's what I've been hearing from, I just had Michael Pinto on last week, Jim Rogers on. He was talking about that as well. This is normal for a market crash. 50% in 2008, we saw the Dow go from like 14,000 to 6,000 something. So that's normal. Can you get into how do you value the stocks? What is giving you that 50% number?
Well, pretty much any valuation measure you want to apply to the broad stock market indices in the U.S. are up at bubble levels. In other words, price to cash flow, price to smoothed out cash flow, price to earnings, price to dividends. You look at any of that, and you get something that's comparable to 2006, 2007, and almost as high as 2000. And both of those two dates that I just mentioned were followed by huge drops in stock prices because stocks were overvalued at the time. Well, we're back there in terms of valuation right now. So if history is any guide, then stock market returns will be subpar for a long time. And this can play out a couple of ways. One is a really short, sharp drop, like in 2000 or 2008, when we get down to fair value right away, or a longer dragged out kind of thing where you go 3 or 4 years where stocks just tread water and their net returns are basically zero, and that brings things back into balance. I suspect, given as volatile as the financial markets are and as much debt that there is out there, that the short, sharp bear market scenario is pretty much baked into the cake. Once things start to look like they're not perfect anymore, people are going to bail en masse. You'll see everybody running for the same exit, which is way too small to accommodate them all, and we'll see air pockets under a lot of these stocks. Same thing with bonds, which has already started to happen. The bond market, especially for government bonds, is in a fairly serious bear market right now, which is to say interest rates are rising. And of course, that has an impact on other financial instruments because stocks, for instance, are valued relative to bonds. You look at the dividend that you can earn on a large cap stock, compare it to what you get from a treasury bond, and you want the large cap stock to pay you at least as much as the treasury bond and maybe a little more. When that stops happening, it's safer and frequently wiser just to buy the long-term high-grade bond and sell the stock. So rising interest rates, though this isn't always the case, have traditionally led to equity bear markets. You see the Fed funds rate, for instance, rising during the late stage of a stock market bubble, and then stocks tank. And so you can attribute some causality to those rising interest rates. Maybe not 100% causality, but the coincidence of those two things happening is strong enough to imply that there's some causality. When rates rise, stocks go down. So, we're seeing stuff like that now. We're seeing interest rates finally start to go up after being unnaturally low for a long time. We've seen stocks rise to valuation levels that traditionally, or at least historically, have preceded big market breaks. So it wouldn't be a surprise, based on all that, to see us drop back into a bear market. But history doesn't repeat perfectly every single time. So there's no way to know for sure what's going to happen in the next 6 months or a year. But it just wouldn't be surprising to see history repeat fairly closely. In other words, we see a repeat of 2008, 2009, and the year 2000 in fairly short order. So we'll see.
Definitely. And just to give people context of how high interest rates are rising right now on the 10-year Treasury, it's at a 5-year high. It just got to a 5-year high. And I guess getting into like, how does this impact paying interest on the national debt? Because I was just looking at the fiscal year for 2018. The U.S. paid almost, actually over $500 billion just on interest on the national debt.
Yeah, that's a longer term problem than stock valuations. Stock valuations might be more of a short term thing, but the interest that we have to pay on government debt in a rising interest rate environment becomes a really serious problem out there at some point. For instance, if our average interest rate in the U.S. for the U.S. government went back to just historically normal levels, not extremely high levels, just kind of what we thought was normal in the 1990s, for instance, our interest bill would be $1 trillion a year. And that's on top of the trillion or so dollars that we're already borrowing in order to cover current spending. So if we were running $2 trillion annual deficits for as far as the eye can see, you got to figure that's going to affect people's opinion about the U.S. government's creditworthiness, and therefore about the value of government bonds. So we risk getting into a situation where rising deficits because of higher interest costs spook the bond markets, which push up interest rates even further, which increase deficits even further, and so on, until you get a kind of a death spiral in which the currency is the final casualty. In other words, nobody wants to hold dollars in that kind of a situation. So the dollar plunges in value and the Fed loses its main tool for being able to manipulate the economy, and it's game over for the fractional reserve banking, massive government spending, fiat currency regime that we've been under basically since the early 1970s. So that is the end game for today's system. And rising interest rates could be the catalyst that brings that about, because there's no way the current global financial system survives a return to normal interest rates, which is that's really the problem with QE, okay, or ZIRP. Unnaturally low interest rates and aggressive government currency creation lead everybody else to borrow money besides the government that the Fed is trying to finance. So you create a really highly leveraged society that has borrowed at really low rates. Now, when rates go back up, everybody has to refinance their debt at some point at these higher and higher rates. So everybody's finances deteriorate continuously over time as rates go up. And that has a really destructive impact on a society that depends on new debt every year. In other words, if our interest costs keep going up, that crowds out everything else we could do, including take on new debt. If we can't borrow more to finance our old debt when it comes due, then we default, right? Or we have to cut spending to the point where life isn't what it used to be. Governments, if the federal government had to cut $2 trillion out of its budget, you can pretty much say goodbye to 70% of the stuff that regular people count on from the government year after year. Same thing for state and local governments. If pension obligations and other debt basically bankrupts them, then libraries close, roads don't get fixed, police and teachers and firefighters don't get their pension payments, and we kind of devolve into what we used to think of as a third world country. And I know that's kind of a strong statement, the U.S. becoming a third world country, but if we had to live within our means, if we couldn't borrow, every level of every part of the U.S. would see a huge drop in its quality of life. So it would certainly feel like we were heading into, banana republic territory. And the numbers point to that. It's not an ideological point to say that we're heading that way. And it's certainly not, mystical, magical thinking kind of thing. It's just the numbers are trending that way. And unless they stop trending that way, we hit that point in relatively few years. So that could be spooking the financial markets too. Maybe they're finally extrapolating beyond 6 months and they're looking out 2 or 3 years and extrapolating today's interest rate trend and saying, oh, we're dead. If this keeps going, it's over for the financial system that we have come to expect as our birthright. So this is a really big deal, Elijah. Let any of several major trends continue right now for just a few more years, and the world changes.
Now, I'd like to go from the U.S. to a more global view, looking at the Eurozone right now. Angela Merkel seems to be losing her coalition, some of the people. How will this impact the Eurozone? Because, we were talking before the interview, and you were making the point that Germany is really a main player in the Eurozone, right? So how does Angela Merkel, losing a lot of her supporters, impact the Eurozone?
Yeah, well, Germany is the pillar of the EU and the Eurozone. You take it out of the equation and the thing just falls apart. And in Bavarian elections that were just completed this weekend, Angela Merkel's coalition partner, in other words, the party that she needs with her in order to stay in office, had a horrible showing. The far left Green Party and the far right, I can't remember the name of that party, but the far right party in Germany, both did better than expected. And the center party, Angela Merkel's coalition partner, didn't do well enough to necessarily stay in power in Bavaria. And what that means is Angela Merkel's coalition might fall, especially if there are another couple more elections like this. But this election alone could conceivably do it. And then Angela Merkel is no longer the chancellor of Germany, and some new coalition has to be cobbled together that will include these fringe parties, formerly fringe parties, that are moving into the mainstream by getting a lot of votes. And at that point, you got something that looks suspiciously like Italy, a coalition of people who really don't trust the Eurozone. They don't necessarily want to keep the euro as their currency. They don't trust immigration as it's been practiced by the current powers that be in the European Union. They don't like austerity, in which governments are forced to limit their spending. So give Germany a government that sounds and acts like Italy's current government, and it's not clear what happens to the Eurozone. I think one almost certain outcome of something like that would be a big devaluation of the euro. And that would roil the global financial markets, because the euro is the second most important currency in the world. The EU is the biggest single economic bloc in the world. And Germany is a crucially important country on so many different levels of global trade. And so throw all of that into turmoil, and it's not clear how the global financial system copes with it, because there are trillions of dollars of euro-denominated debt out there. There are some of the biggest banks in the world are European and would be threatened by what I just spelled out there. So this is a fairly serious deal. Germany has to keep it together for the Eurozone to keep it together. And the Eurozone has to keep it together for the global financial system to maintain an even keel. So it's a big deal, and the Saudi Arabian thing, if it affects the price of oil, is also a big deal. So there's some serious stuff going on out there. And it makes the emerging market currency crisis, which has been the big scary thing going on in the world for the last few months, kind of pale by comparison. And so it's still out there. The stronger the dollar gets, the further and further these emerging markets get pushed into the red on their dollar-denominated debt. And the harder and harder it becomes for them to pay off those debts to the European banks that lent them all the money, and also to the U.S. banks that did. So, Elijah, there's a lot going on out there, and a lot of it is very scary.
Yeah, and I mean, one of the things that we did see last week as stocks were going down, which is kind of interesting because a lot of the time we've been seeing gold and silver and stocks kind of when there's a stock crash. For example, in 2008, we saw gold and silver go down at first. But right now, what we saw last week was gold and silver spiked last week. So where do you see them going in the near future? And why do you think that happened?
Well, there's this idea that that gold and silver tend to move in the opposite direction. In other words, stocks are risk on, gold and silver are risk off. So when the psychology shifts one way or the other, you get these asset classes moving in the opposite direction. That, as you said, that's not always the case, because if stocks have a 2008 kind of crash, that's extremely deflationary. So people expecting a deflationary depression, which is what a lot of people were worried about in 2008, that leads you to not really feel like you need an inflation hedge, right? So you don't need to buy gold under those circumstances. And it also leads you, if your stocks are tanking, you're getting margin calls and stuff, you might have to sell your gold and silver. So even if they aren't down that much to begin with, or especially if they're not down that much to begin with, they become something where you can raise cash. And so you end up selling your good assets like gold and silver in order to cover your losses from your bad assets, overvalued stocks. However, that coincident behavior, correlated behavior, doesn't necessarily last for very long, because a big drop in stock prices tends to lead central banks to respond aggressively by cutting interest rates. And that's generally good for gold and silver, because they don't pay dividends, gold and silver. So when you store them somewhere, you got to pay storage fees. And if you could get 5% on a bank account, then that 1% storage fee that you've got to pay on gold and silver, it just doesn't look very good by comparison. But when interest rates go down to close to zero, then all of a sudden gold is actually a superior instrument from a cash flow standpoint, or close to equal at least. In a negative interest rate world, it becomes superior. So once we start trending in that direction, once central banks start cutting aggressively, then gold and silver catch a bid. People start pouring back into precious metals, and you see the price go up. That's what happened in 2008. When gold and silver tanked, they didn't stay down long. They bounced off that bottom and they took off. And through 2011, 2012, they had one of the best bull markets in precious metals ever. So for gold and silver to be tracking stocks as stocks go down right now, if that were to happen in the future, it would still be a fairly positive thing for gold and silver, because it just makes it cheaper and you can buy it towards the bottom and then ride it back up when the central banks start to panic. But they're not moving in the same direction right now. It could be due to a couple of things. One is that people haven't figured out that this is a real stock market crash, which is actually very deflationary. And the other is that people are starting to think about the ramifications of even a garden variety bear market in equities on the fiat currencies of the world. You know, if you think we're creating enough debt to create the possibility of a currency crisis out there, then you want to be loading up on gold and silver. And the scarier the world gets, if you think the ultimate outcome of today's scariness is a currency crisis, the more attractive gold and silver become. So it could be that we're finally wising up to the implications of all this debt and starting to hedge ourselves against those implications with gold and silver, regardless of what stocks are doing. Now, I don't know which one of these will turn out to be true, of course, but they're both plausible scenarios. And either way, see, the important thing is either way, 2 years down the road, gold and silver are things you're glad you bought now. Even if you lose a little bit in the short run, you end up in a bull market one way or another that will take these metals a lot higher than they are now. You know, I think that we could finally see that $5,000 gold price target that has been tossed around for such a long time in the next cycle. And if gold does that, then silver will just rocket. You know, silver will go up more than gold did, which takes silver above $100 an ounce. So, and I know I've been saying this for a while, but it does feel like we're getting closer to the point at which any bad news in the economy becomes bad news for the currency, and by implication, good news for precious metals. So that day's coming, you know, whether it's next year or 5 years from now, it's out there. And the people who have been stacking all along will be really happy when it happens.
All right. Well, John Rubino, thank you so much for giving us your time today. Before we let you go, did you want to share with the viewers any last thoughts you had, and then where they can find you online?
Well, we covered enough of the crazy stuff that's going on in the world that I won't depress anybody anymore. But for ongoing coverage of this stuff, I manage dollarcollapse.com that basically continuously updates a links list and some original content that deals with a lot of the things we just talked about.
All right. Once again, thank you so much for your time.
Thanks.